This week on Wealth Track, with both stock and bond markets trading near historic highs, alternative investments master Cliff Asness shows how he juggles market risks with the search for better returns. AQR Capital Management's Cliff Asness is next on Consuelo Mack Wealth Track. I began the conversation by asking Asness how unusual it was for both stocks and bonds to be this expensive at the same time.
That is the really unusual part. Again, roughly the 90th percentile more expensive than history for stocks, roughly 90th percentile for 100 some odd years. So only 10% of the time have bonds or stocks been more expensive individually.
So that's kind of scares me. Here we have,
I apologize for that,
the two major asset classes that individuals own in their portfolio, stocks and bonds, and they're really expensive together.
Yes.
What do I do with that information? I mean, what do I do with my portfolio? Should I be, paring back in both my stocks and my bonds? What's the response to that?
It's the big question. Information is great. What do you do with it?
Yeah.
I will admit, I think this is my honest opinion with a little bit of cowardice thrown in, but I do not go out to people and say market time, pare back. I don't do that for a number of reasons. For one, 90th percentile, there's something called the 100th percentile. And then not all 100th percentiles are created equal. You could be the highest ever by double, or you could be barely touching the highest ever. Timing these things can be very difficult. And when people try to time them, they often have strong conviction at the beginning. It doesn't work out for 2 or 3 years because things get more extreme. They cave, the round trip is ugly. In general, timing is dangerous. If we ever got to tech bubble-like extremes for either the whole portfolio or either one, I have the hubris to think maybe at those extremes, and I'll still be wrong by a year.
Right. You'll be early.
But if we got to 50% worse than we've ever seen before, way past the prior 100th percentile, I think I would come here and tell you, now's the time to do something odd. But even at the 90th percentile, I do not encourage people to time the market, to pare back, to hope for a dip. We might never get it. It might come tomorrow, but we might never get it. We might just make lower returns for a really long period. The most important thing you can do is just factor it into your planning. Information is power. When you sit there and say, and this applies to a pension fund, it applies to an individual with a spreadsheet or a piece of paper. What do I need to save for retirement? If you are counting on the historical returns of stocks and bonds, which is about 5% over inflation, or the really low ones now are 2.5%.
And that's what I wanted to ask you. Therefore, if stocks and bonds are expensive historically, therefore our expected returns are no longer going to be, you were just talking about real returns of, let's say, of 5%, that's ex-inflation. You put inflation on top of that, and it could be what traditionally 7 to 8%.
Yeah.
Right?
If you have 2 or 3 inflation, sure.
Right. And therefore, what are the expected returns? Now, you just said 2.5% real.
2.5% real, so if you do the same exercise.
Right.
And again, if inflation is different, the answer will come out different. This is assuming we get somewhat near.
But still, that's half the 5% that we've had that we've been used to.
But if this number were actually negative to inflation, and not 2.5% real, negative 1% real, meaning inflation, economists were coming out with forecasts of inflation that were larger than the yield in the stock and bond portfolio. I would tell you that's a bubble.
Right.
If I believe those numbers, I would say that's a bubble. That makes no economic sense. At 2.5%, I can only tell you it's expensive versus history. This could be what the market has decided is it's going to be. Now, it could change back tomorrow. We don't like to forecast that. We think a lot of people go broke trying to forecast that. But anyone saying, how much do I need? It's bad news. I won't pretend it's good news. Anyone saying, how much do I need to save to retire? How much do I have to put in stock and bonds into a portfolio? If that's your investment and it's going to make less, you need to know that.
Right. You need to save more, right?
You need to save more, spend less, work longer, all the bad things.
Asset allocation. I mean, number one, you are a huge proponent of diversification.
Diversification figures very big into what we do at our firm at any stage when it comes to how to try to add value and combine different signals in the alpha or the style tilt world, things you and I have talked about before and probably will again. But when it comes to asset allocation, just your weights in stocks, bonds, commodities, international versus the US, we are always pushing on the diversification front. We are big proponents of global as opposed to single country. That's for both stocks and bonds. At the very least, we think it does no harm. At the most, we think it protects your portfolio, and we've written a paper on this for some truly terrible long-term periods that happen in individual countries more often than the globe. It doesn't, interestingly, protect you from crashes. When you have short, sharp panics, the world tends to panic at the same time. At least that's been the historical result. But it does protect you from finding out your country is the sick man for the next decade. So
right. So it's very important to diversify globally.
And it falls out of favor from whatever country's perspective, right? This is a global world. We're sitting here in the U.S.,
right now,
but wherever
US
you are.
Is very popular. It's done really well. It's led.
And I think some of the better strategists are out there saying, you know, don't give up on international. You want it all the time for diversification and totally separate. I do think it's some of the cheaper parts of the world, particularly on the equity side. On the bond side, I think the rest of the world maybe is even worse than the U.S. So being global. The second is asset class diversification. This is more controversial, I'll admit. It's a little more off the beaten path, but we believe in it strongly. A traditional portfolio is mostly dominated by equities. If you put 60% of your money in equities and 40% in bonds, and I don't know anyone with actually a 60-40 portfolio, but we all use that. If you do that, equities, sure, they make more, but they move around a ton more for the good and the bad. The bonds, I like to say they're diluting, not diversifying. They're dampening the returns, but they're not enough of an equal partner to equities to actually matter. So 40% in a safer asset does dampen the returns, but it doesn't diversify them. It's not that different from having 40% in cash, frankly, at that level.
Mm-hmm. You're actually saying at a time when everyone is saying bonds are really more expensive, and that one should be avoiding bonds. That's what a lot of people are saying. You're actually saying no, in fact, that bonds are not necessarily your enemy, and that stocks, the stock-centric portfolios, which most of us have, are actually not the way to go, right?
Sure. If we have a truly terrible economy, they're pretty much the only thing that's going to work. Mm-hmm. They perhaps have more of an insurance role than a diversifier now. It's a slight, subtle difference where it's hard to argue they're going to make a ton of money. But being the only thing that can make any money in a disastrous economy is not terrible. Do I wish they were more attractive? Sure. But I'm much more concerned about the combination of the two.
Then there's commodities, right? And so that's the third major asset class that you believe that we should all have exposure to. Correct?
I do. Not as large as the other two.
Right.
Both the economic story and the theoretical story for the exposure is not as strong, but we think strong enough that you want it. And its empirical properties of being one of the only asset class. If you think of the two big things that can happen to the economy, growth and inflation shocks. This world where we get a bad inflation shock, and growth can do either really, but a bad inflation shock is very bad for bonds, not particularly good for equities in the short term. Maybe in the long term they can make up for it, but not, an equity investor's not saying, yeah, I'm really looking forward to that inflation shock. Commodities have been the only thing, with the 70s being the canonical example of when they were really the only asset class to make money. So we don't think they become an equal partner with stocks and bonds, but a non-zero permanent allocation to them makes sense to us in our strategic allocation.